Chief Investment Advisor, EGSI Financial. Thank you for being here. So the feeling is, look, we saw this great rally and maybe there's some profit taking yesterday and today, but then what?
Well, thanks for having me back. And I do think that the market is going to finish up strong. We are going to have that Santa rally, and the main reason is bad news is good news when it comes to the economy. I mean, we saw jobs numbers below expectations, jobs claims are up, and really when we look at this, when we have a slowing economy, really the only thing that the Feds can do is lower rates, and as they lower rates, I mean that's good news for the markets, and I think the market is going to continue to rally. Although I'm very cautious with saying that it's a full-on bull market.
All right. So when you say bull market, what are we looking at here? I mean, what kind of near term and longer term are you thinking?
Honestly, I was a big time bear, especially at the end of October. We saw oil prices 90 plus a barrel. We saw the 30-year fixed mortgage 8.3%. Everything was kind of flipped on its head. I mean, we even saw the 30-year yields over 5%. But as soon as November hit, bond yields started to go down. We saw the 30-year mortgage rate go down to below 7%, where it is right now. We have oil prices in the 70s. And, obviously we're in the election year, and not to be a cynic, but it's already starting. So I think what we're going to continue to see is, as the economy worsens, I think we're going to see a recession next year. I don't know how big it's going to be, but I think we're going to see it. And the last thing that the Feds can do is really lower rates. We may even see another round of quantitative easing, depending on the economy. We'll see lower gas prices, and everything is going to depend on the outcome of the election. But we have an underlying crisis, which is debt. I've been talking about this debt bubble, not just on a consumer level. I mean, consumer debt is at an all-time high. It's over 1.3 trillion just in credit card debt. We've got the national debt, as well as all the unfunded liabilities we have as a country. So we're over $200 trillion in debt. So I think that this little bit of a bull market, which is why I'm cautious, it's going to be short-lived through the election, depending on the outcome of the election.
And so it's interesting because sometimes you would say that they try to run up the economy or make, the Fed sort of stands pat and doesn't do anything ahead of an election because they want things to appear better. So at this point, we've had a winning year, right? When you look at the S&P, the S&P is up 19%. The Nasdaq's up 35%. Is it going to be a winning year next year for stocks, even if we have a recession?
I think it is, just because of the fact that they're going to be lowering rates. And I think the real telltale sign is going to be, small cap stocks. That's the lifeblood of America. And if we see like the Russell 2000 continue to rally throughout next year, I think it's going to be a little bit longer term. But yeah, I do think the stocks are going to finish up. The markets are going to finish up strong, at least up until the election. And then depending on the outcome of the election is really going to determine how the year finishes.
Yeah, so that's part of it as well. So when obviously there's going to be some telltales. You're looking at the small caps, for example. What other areas do you think should be in focus, or what would you recommend? Because it sounds like you're going to be watching small caps. Doesn't sound like you necessarily believe that that's where you should put your money to work. Where should you put your money to work?
Well, I still like hard assets, but I'm really liking industrials. I'm liking healthcare. Both of those have been hit relatively hard. And, those companies have very, very strong balance sheets. And so any of those companies that, have strong balance sheets, that are value, that are providing dividends, especially on the commodity side as well. When you have gas prices and oil prices as low as they are, there's some diamonds in the rough. And that's really what we're looking at, those sectors that we have the biggest potential for growth. I mean, you really can't pick the top or the bottom of a market. You really have to look at, what is the strategy that you're trying to employ, over the near term, and also protect against, any downside risk, past this next year. But that's really what we're looking at.
So as a cautious bull and one who believes the market goes up because the administration sometimes finagles things, any administration, no particular side, but they want to make sure you have a good economy, gas prices are low, right? And we've seen it in history. So would you say you'd be wrong to be on the sidelines in cash right now?
Yes, because as interest rates go down, bond prices are going to go up because that cash is going to continue to be devalued. So, we have not been a believer in bonds until recently, until we really started seeing, interest rates, start to come down and those money market rates start to come down. So I'm really liking bonds. That's another good play. But if you're just sitting on the sidelines in cash, as rates continue to go down, so is the returns on that cash.
Right. And, as we've been watching Treasury yields coming down, we're waiting on more on the jobs picture. We got the JOLTS report today. What are you watching when it comes to the jobs picture and how it could affect stocks?
I think that the jobs numbers are going to continue to come down, even though they've been boasted being higher, each and every month up until this month. If you go back and you look over the last several months, they've been revised downward, month after month after month. And I think we're going to continue to see that going into the first of next year. But it really is a double-edged sword, because when you're looking at the stock market and you're looking at earnings, on these companies, as the recession gets tougher, revenues and earnings are going to continue to go down. But, again, as interest rates go down, people are going to look for a place they have to generate some sort of revenue and income, especially for retirees. And so this is what we saw over the last 10 plus years, is really the only place for that is going to be the stock market. But again, you really need to hedge your bets and making sure that you're taking the risk that you should be.
All right. Ed Siddell, EGSI Financial. Thank you so much for being with us. Appreciate it.